everyone. This is Ready to Scale. I'm your host, Ellie Perlman, broadcasting from the beautiful, sunny California. Today, we're going to talk about how sophisticated families hold real estate. We're going to cover structure, taxes, and access to real estate. Maybe this is not the most interesting topics, but it is, I guarantee you, one of the most important ones. So imagine there are two families that invest $1 million each in the same apartment community, same day, same terms, same location. 5 years later, the property sells and the deal performs identically for both families. But one family nets meaningfully more. They keep more cash, they defer more tax, and sets up the next investment better. So same assets, same gross return, but the difference was everything that happened on paper before and after the wire. So today is all about the paper, the structured taxes and access, the least glamorous part of real estate investing, but possibly the most valuable, as I mentioned. So let's dive to it. And before we're going to get to it, just one thing I wanted to mention. This it's pretty standard, but a very sincere caveat. I'm a real estate sponsor. I've built Blake over a decade ago, or about a decade ago, and my background is in commercial real estate law and then asset management. I'm not your tax advisor. I'm not your attorney. Everything today is a map. It's not advice. So the territory belongs to your CPA in your counsel, your tax advisor, etc. And honestly, if this episode does nothing but gives you, sharper questions to bring to them, I've done my job. All right. So let's get started. So private real estate earns its place in everyone's portfolio. When I say everyone, I mean high net worth, ultra high net worth, family offices, and institutions by doing four jobs at once. First and foremost, there's current income because with multifamily, for instance, you have tenants that are paying every month. It's also an inflation protection because rents essentially reset every year. Leases are for 1 year, but bond coupons, they don't reset every year. So in that sense, there's an ability to adjust rents based on or against inflation and increase it as inflation increases. Also, and that's the third thing, there's low correlation to whatever is happening with the stock market on any given Tuesday. And the last part, which is what we're going to talk about, is a tax advantage that is compounding. And this is a big one. And so family offices and sophisticated individuals, they commonly hold a meaningful allocation to real assets, but the right number, it's less about percentage and it's more about liquidity tests. Private real estate essentially locks in capital for years. Once you invest, you can't, unless you're in a REIT and there's specific, I would say, specific terms on redemption. Usually in real estate, once you invest, your capital is locked for years. It can be locked for 3 years, for 5 years, for seven, maybe even 10, depending on the fund and the deal that you're investing in. So the only capital that belongs in it is capital that you genuinely don't need in the next, several, I would say 3 to 5 to 7 years. So illiquidity is fine, but surprise illiquidity is how mistakes essentially happen. And, essentially, when we're looking at real estate, just to take a step back, there's a few ways to invest. There's kind of three different vehicles and three different essentially paths to do it. So first and foremost, you have the public REITs, which many investors have access to. That gives you instant liquidity and instant diversification. But you're not buying real estate, really. You're buying a stock in a company that owns real estate. So it trades with the market, and you lose most of the direct tax benefits because this is not a direct real estate holding. That's one thing. But of course, the benefit is that it is liquid. The second vehicle is essentially invest in a fund. So you can essentially diversify across different deals and different market and sometimes even across different asset classes. But you're committing to a blind capital and also, you're paying a certain fee like you are with a direct deal with REIT. Nothing is different there. But you don't have control over the type of deals or the markets that the fund invests in unless you are backing the fund, you're one of the first or the biggest investors, and you have some say in it with some decision rights. The third vehicle is direct investments. So if you invest on a deal by deal basis, and many of my investors do that, and then we also have investors that like the fund diversification. They don't have the bandwidth or the knowledge to look into specific deals or markets. So at Blue Lake, we actually offer both of those paths. We do not have a REIT, not a public REIT, not a private REIT. And so those who choose to invest in real estate through the direct route, essentially they get to choose which deal to invest in, which market, which sponsor, of course. And when it comes to investing directly, you do need a little bit more time to allocate to it so you can look at the market, the underwriting, the business plan, the debt structure, and make an informed decision whether this is the right one for you. So, of course, between the REIT and the fund slash direct investments, the main difference is liquidity because you are liquid with REITs, but you're not liquid with funds and direct investments. But unlike REITs or funds, when you invest in direct deals, you have more control over what type of deals, debt structure, and markets your money goes to. And when it comes to the tax benefits, it's actually a lot more significant when it comes to direct investments in funds and not so much with public REITs. And we're going to talk about that in a bit. So it's really interesting to understand that there are many ways and vehicles through which you can invest in real estate, and they all provide their different pros and cons. And by the end of the day, every investor needs to sit down and understand what's more important. Is it liquidity? Is it control of or decision about which specific market, specific deals to invest in? Or is it the tax benefit, which is huge, and that's essentially something you don't really get with a public REIT, just because the way that it's structured, because you own a share, you don't really own real estate, and that's why you lose. That's one of the reasons why you lose the tax benefits. And I'm going to walk you through how we do it at Blue Lake and how significant that is, and how many different tax vehicles we have that we offer to our investors. Now, um, if you're listening to this podcast, you could be an allocator or a director at an institution or a family office or a private investor. Many times when you're looking at deals, there's some deals that and funds that are open to private investors and family offices that are not open to institutions. Sometimes smaller deals, for instance, 20 to $50 million deals are too small for institutions, or a $50 million fund is too small for institutions. And so they have their own mandate. And so they can't really access those. So that's just something to keep in the back of your mind, that some institutions, such as endowments and pension funds, they can't really write a small check. $5 million, $10 million is too small for them. And so they usually would invest in funds that are bigger. It's normally 100 million and beyond that. And so when it comes to looking at really good deals that institutions do not participate in, these are the deals that are open to you as private investors and family offices. And so this is essentially where it's kind of like a privilege. One of the privileges of private capital, institutions for the most part, they buy blind pools or they participate in really large deals. But a lot of the opportunities that are also enhanced with the right tax structure is many times open only to private investors, high net worth, ultra high net worth, and family offices. So let's start with the most significant tax vehicle that we are using at Blue Lake, and that's depreciation. So the tax code treats any building as an asset that wears out and over time goes down in value. So owners can deduct a slice of its value every year. So even if the property appreciates and pays you cash, the result is that you can receive real cash distribution while your K1 shows little or maybe even negative taxable income. Because technically, based on the tax code, your asset a year after you purchased it is actually worth less than it was a year ago because now it's older, meaning it does not worth as much as it was a year ago. But even if the asset is 1 year older, in the meantime, maybe you've made 50 or $100,000 in cash flow, it doesn't change the fact that the asset actually depreciated. So the distributions and the tax bill are two different numbers, and that gap, that's the engine of real estate tax efficiency. And essentially, when we create K1s, many times you'll see the actual positive number of cash flow that investors receive, but then you see that their taxable income is actually negative. And if you've never invested in real estate, you can look at it and say, well, this person is losing money, but it's quite the opposite. They made money, but because technically on paper, the asset that they own depreciated over that time frame, they are capturing some paper loss, which essentially is as big or bigger than their distributions. So essentially, their taxable income is zero. So whatever they make, they get to keep. Now, there's a caveat to it, which is, let's say 5 years down the line, they actually sell the asset and they sell it at a profit, then essentially the IRS says, well, we accepted your position that every year the asset depreciated in value, but now after 5 years, you just made $5 million of profit, which means that the asset appreciated. And there's something called depreciation recapture. And so now the IRS wants you, if you made profit on the back end, to pay the difference of what you would have paid if you didn't have the depreciation to begin with. A way to go about it is, and bypass it legally, of course, is to do a 1031 exchange and say, well, all of this is nice, but the 5 million, I'm not touching them. I'm going to defer this to the next deal. And then you avoid paying those taxes, or at least you defer them and, to the next deal until you decide to liquidate and pull the money. But we're going to talk about 1031 exchange in a bit. So depreciation is the first tax vehicle that we essentially use and many other real estate investors use in their investment. Now, the second vehicle is cost segregation and bonus depreciation, which we are using together. So now, we talked a little bit about depreciation, and now let's accelerate it. So a cost segregation study essentially breaks the property into certain components. Instead of one unit of an asset, it's broken down to carpets, appliances, walls, etc. So the tax code actually lets you depreciate each component over 5 or 7 or 15 years instead of over 27 and a half years. So essentially, the tax code can say that carpets depreciate over, let's say, I'm making those numbers up, 5 or 7 years. And when you do that, you don't have to do a straight line calculation of a fraction of depreciation every year for 27 and a half years. You can essentially take that period of time and compress it to 5 or 7 or 15 years or whatever that is based on the component of the asset, whether it's appliances, they depreciate faster than the walls, for instance, or the windows. And so that is a very powerful tool that we're also using at Blue Lake. And if you add to it bonus depreciation, which Congress restored to 100% last year, you get a large share of those deductions that you can use in year one. And so what happens is that in year one, if everything goes well, of course, you get distributions, but you get a very large number of paper loss through depreciation, through cost segregation, and bonus depreciation. So you capture the maximum amount of depreciation in year one. And whatever you don't use, assuming that your CPA can bill it correctly for you, you can use the delta in the next year, etc. So there's a very meaningful first year paper loss in your K1 that we're providing to our investors, and many sponsors do the same, that they sit there alongside actual cash flow, actual profits. So for investors with the right income profile, that's the single most powerful feature in this asset class. And again, I'm not a CPA. This is not any investment advice or tax advice. Every CPA and tax advisor can essentially talk with you and explain how to structure it, and whether you're a real estate professional or not, how much you can use of the depreciation and the paper loss. Every investor and every family is different. But what we do is essentially use the bonus depreciation with cost segregation together to create a very powerful machine that lets our investors capture the maximum amount of tax depreciation and paper loss to counter for every dollar that they make in profit. So we talked a few minutes ago about the 1031 exchange, and I want to spend a few minutes on it. It's a little bit of a complicated structure, a little bit expensive, but it's so worth it, in my opinion. And we've done it before several times where we were selling an asset and we wanted to provide investors the option to take their gains and their principal and shield the income, the profits from taxes by essentially deferring paying capital gains tax and what I've mentioned earlier about the depreciation recapture, by essentially moving that money, the profits from the sale and getting their initial investment back, deferring this to another asset, another investment. What it takes is, I mean, first and foremost, when you invest with a sponsor, just make sure that they do offer this option because not everyone does that. Um, there's usually a very specific timeline to identify the next deal that you want to transfer the money to and to close it within a certain period of time. The capital gains tax and the depreciation recapture, they don't just vanish because you move the funds to and you exchange them with another asset. They're just being deferred. Meaning, as long as you do that and you move the money from one asset to another, you do not need to pay those taxes. Of course, another disclaimer, you can see I used to be an attorney in my past life. The IRS can always challenge any 1031 exchange. No exchange is immune from any, from the IRS to look into it and say, this is kosher, this is not kosher, this, I approve the structure or not approve the structure. But many family offices keep doing that where they invest one time, they sell after several years, could be a decade or two. And I've met those families also. And then they take the gains and the principal because you can't just defer the gains, and they invest it in another asset. And they keep doing that from one asset to another, over and over and over again. There's no limitation to how many times you can do that. And, this is called swap till you drop. And essentially, it's really the cornerstone of how multi-generational families hold real estate. Now, some people would ask, okay, so how do they make money? I mean, they don't they want to take the profits and do something with it? And well, once they invest, they do have the cash flow that comes in every month or every quarter or every year. The second part of it is I know some families that the structure for them is to do an exchange, and once the asset is prime for refinancing, once NOI grows and the valuation increases, then they replace let's say they took a $10 million loan and now the market shifted from a 60% LTV to 65% or 70% LTV, while the NOI grew 25% and valuations went up, which is a dream scenario for every real estate investor. And then they took the $10 million loan that they had and were able to replace it. And I'm just throwing numbers out there, there's no real math behind it. But they were able to replace it with a $13 million loan. So now they repaid 10 out of the 13 million to the prior lender, and the other 3 million they pull as a cash out refi. Now, when you do that, you're not supposed to pay gains or taxes on the 3 million because they're not gains, they're not capital gains, they're not cash flow. It's not cash flow, it's sale proceeds. So essentially, you don't need to pay taxes for it. So that's a very interesting way of extracting value in cash from real estate without paying taxes. So some families that keep doing that over and over and they play and move that money with the intention of essentially limiting the amount of tax that they need to pay. Now, one of the most important things right now, we talked about real estate and the tax structure between cost segregation, depreciation, bonus depreciation, and 1031 exchange. If this is something that you think can work for you, and you're looking for a sponsor that you can invest with that would give you those options, then the question is, okay, which one to go with? And the first one is, of course, the one I would always ask a sponsor if I were an LP or family office. Do you offer 1031 exchange? Do you offer cost segregation? Do you conduct cost segregation study on your assets? And do you apply bonus depreciation to make sure that they are set up in a way that would help you maximize paper loss and minimize your taxable income? Now, beyond that, I always like to give that advice to LPs. Ask them hard questions. Ask them which asset did not perform, what was the hardest vintage, and kind of listen to them speak about it. If a sponsor, says, well, everything is fine, we've never lost money, we've always paid based on projections, which I don't even know, even Blackstone, well, I'm not going to say the name, but even the big guys over there, statistically, there's no way that they paid every quarter based on projection across the board for 100% of their investment. That just does not exist. There's always some pain and nobody's immune to it. Nobody's immune to any change in cycles. And so, but the most important thing is not if they've had pain, because they haven't. If they tell you that they haven't, they are not being truthful with you, or they're not experienced enough, so they haven't had enough experience, enough assets under their belt to encounter one. But it's really about how they're communicating. And if they're truthful, if they're telling you about how they dealt with it, what happened, what they've learned, then it's a pretty good insight into how they will communicate with you if something goes sideways, if the investment is not working as it should be. So that's something that I would really pay attention to. Also ask them for a sample reporting to see how professional and how in depth they do go into those monthly and quarterly reporting to see if this is something that fits you. And also, when it comes to underwriting discipline, you want to understand how they stress tested the deal, and especially what are they thinking about debt? What are they thinking? How are they thinking about revenue growth? If they need 5-7% rent growth year over year, that's extremely aggressive in today's market. And I would want to understand why. I can tell that I would be very hesitant to invest in one of those deals. But if someone is looking at 0 to 2% rent increases, that is something that is more in line with where we see the market today. So it's very, very important to understand that. The last thing that I would say is ask about alignment of interest. So I can tell you that at Blue Lake, we have a certain preferred return that we offer to investors, and the arrangement is 0-100 split until you hit that hurdle. So if we give out 8% preferred return, or if we offer that, until investors made whole with their original investment at exit plus 8%, unless there are other debts or other reasons why, of course, you need to pay the debt first and outstanding invoices. But assuming that all that is cleared, it's always a zero, or usually it's a 0-100, meaning 100% of the sale proceeds go to investors to return their original investment in to pay 8% of their money year over year. And only then we have a certain split of equity. So that's a key thing to make sure that you have it because not all sponsors have it. And we created it in order to give investors peace of mind that their money is going to be, that the proceeds from the sale are going to go to their money to protect it as much as possible. So these are just the things that I would pay attention to if I were looking into investing with a sponsor today. So I created a sponsor diligence checklist where you can download it from our website, where you can essentially use it and make an informed decision before you move forward. There's a section there about taxes to understand what are the tax vehicles that this sponsor offers to make sure that the structure that they have in place maximizes the returns and minimizes your taxable income. So if you want the sponsor diligence checklist, go to our website and you'll see it there. We're also going to post a link to that page. So it's a free download. You can just go and look at it and download it at any time. So if you've been with me through now it's the third episode of our new season, we really covered a lot. And today's episode was about tax. I know it's probably, again, like I've started this episode, not the most interesting topic, but trust me, it's very interesting to see your income maximized, which is, that's something that I'm passionate about. And again, I'm not a CPA or tax advisor, but this hopefully gave you the right framework to understand the benefits of investing in multifamily in, between different structures, REITs, funds, and direct investments. And so, we have pretty good information on the website, which I encourage you to go and check out. And feel free to reach out to us through our website if you have a topic in mind you want us to talk about. I'm always happy to hear from my audience and my investors, and happy to record something that would add value to you. That's it for today, guys. Thank you for listening, and I'll see you on the next episode.